Week ending Friday the 18th, the conforming 30-year fixed rate was sitting at 6.81% according to Mortgage News Daily's rate survey. This is exactly where we were sitting in July of 2024, a year ago. Of course, this rate is with borrowers paying approximately 1 to 1.25 in discount points to get that rate. Listen, man, it's been a tough 2 weeks for mortgage rates as we've seen rates rise almost a full quarter in the month of July. Thankfully, this Friday, we broke out of the upward trend. Check out this 30-year fixed mortgage rate chart. You can see the upward trend that we've been in ever since the beginning of July and the reversal that took place on Friday. I'm really hoping that this starts a rally in the bond market and we see rates heading lower in the future. So what caused Friday's move? Well, Fed Governor Christopher Waller gave a speech in New York and also a couple of interviews this Friday. In the speech, he argued that the Fed needs to cut the Fed funds rate at their next meeting, which is July 30th, just a couple of days away. The markets are paying attention to his comments because not only is he a well-respected member of the Fed, but he's also one of the frontrunners to be the next Fed president.
In terms of inflation, I've long argued that if the effective tariff got down through negotiations to like 1%, 10%, imports make up 10% of the price index. So a 10% tariff on 10% of the goods is only a 1% increase in the total price level. And that's if it's completely passed through. We already know that this is not being completely passed through. Kind of data that's starting to make me a little worried. We're seeing job creation coming down. We're seeing a lot of things like you just said with the Philly Fed that are suggesting that maybe the labor market's starting to soften more than we might want it to. And so in my view, if you're starting to worry about the downside risk of the labor market, move now. Don't wait.
In this interview, he touched on tariffs and the labor market, making the argument that cutting the Fed funds rate sooner rather than later when the labor markets are going to be feeling the pain with higher unemployment rates. Bond traders and experts liked the tone of his speech, and as a result, rates reacted positively. According to CME Group's FedWatch tool, the market's pricing in less than a 5% chance that the Fed will actually cut their rate at this next meeting. So we'll see what happens. Hey, if you like the content, remember to follow me for other great videos. Tune in next week and find out what happened to mortgage rates. As always, thank you for watching. Let's get better. Let's close more deals, and I'll see you in the next video. Bye now.